I get asked this question every single time. Hugo, how do I get a 700 plus credit score? When we're talking about that conversation, there's many different factors that play into making a 700 plus credit score. And that's exactly what I'm going to go over today. The different kind of factors, the amount of percentage that it really takes to build up that profile every single time. So here, I actually pulled this up from Experian. So you can actually go to Experian.com and see this for yourself. A lot more resources that are available, but getting into this here, we're going to talk about FICO 8 scores. This is typically what banks will pull whenever you're applying for a credit card, a loan, an auto loan, different products from these financial institutions. So this is what really matters. First, we're going to start off with the payment history. This makes up about 35% of your score. When we're talking about payment history, it's not a one-time, two-time, three-time kind of situation. We need to be making payments every single time, every single month that a payment is due for a credit card, or auto loan, personal loan, any type of product that you have. That needs to go through every single month to be able to have the most 100% success on the payment history. The next topic that we're going to cover is amount owed, and this is referring to utilization, and not utilization on your loans, on your auto loans, or any of those type of products, because those are already agreed loans that you took and you agreed to pay on a monthly basis for 5 years, 4 years, whatever you chose. But we're talking about credit cards specifically. These are revolving accounts, which means that every time we pay it, we have access to that money again. Okay, so each card we recommend to have under 15%, or even at best outcome under 10% usage reporting every single month. Now, the day that you're able to identify when it needs to be at 10% usage or under is called your statement date. And you guys can actually find this. I'll put up an example right here of where to look for it in your credit statement, but you can find it there. That's the day that it reports to the credit reporting agencies, Experian, TransUnion, and Equifax. Your due date, that's typically the day that you just make that minimum payment to avoid any possible late payments that might report to your credit. So like I said, under 15%, at best outcome under 10% usage per card every single month. That doesn't mean that you can max it out. Yes, you can, but you just have to make sure when the statement date comes, you bring it down to 10% or less of usage of the overall limit. When it comes to utilization, as I mentioned, that is a big factor. So this is an example of $1,000, let's say, a credit limit we have available for a credit card. If you use $900 and you allow that to report when your statement date hits, you are now categorized in the 90% utilization. So that would drop your score dramatically. However, one of the easiest things to tackle is usage. So let's say, for example, that you are using the $1,000 credit and you are maxing it out $900, but you pay it down to $90 reporting. That will put you at 9% utilization, and then that then becomes a responsible amount that you can keep. So your credit score still maintains a healthy overall score. The next thing here is length of credit history. This is a major thing because as you start to have credit cards, you allow it to age, that starts to make your overall history part. The more that you start applying for new credit cards, your average age becomes less and less and less, because now you're adding new accounts to your credit. So we want to make sure that if we do apply, it is a credit card that's worth applying for, right? And that makes up about 15% of your score. So this is an example of how to calculate your overall age. Okay, so let's say we have one card that's already 10 years old, but then we apply to a new card the next day, okay? We now have one that has been about 10 years old and the other one for 0 years because we just applied for it. So now we have 2 credit cards in total. Now, in order for us to find our credit age, the average is by having the 10 years, our oldest credit card, divided by 2, because now we have 2 accounts reporting. That now brings us our overall, which is 5 years of age, which goes from 10 years now to 5 age. You've now officially lost 5 years. This is why it's very important that whenever you are applying for credit cards, that you make it worth it. Let that be a card that can actually benefit your profile, help you in multiple ways, not just because of a promotion that they're giving you at the store, right? So this is very important. This is how you can go about calculating it. So the next thing we're going to talk about is new credit. This is where 10% of your score is made. Now, on this topic itself is every time that we're adding a new account onto our report. So we run our credit, we have a new inquiry, we have a new type of product showing up, 10% of it is really the damage that it does to our report, which is perfectly fine because it comes down to the next thing here, the credit mixture. It's important to have many different products on your credit report to show strength, to show a solid foundation. Every time you're going to like a financial institution, they're going to look at your report. Okay, does this person is asking me for an auto loan for $35,000. Does this person have any history in the past already paid on time, already paid off the car? Do they have any type of history already showing that? If they do, that person now becomes more of a credible client for the bank itself, and they're willing to be open more to lending that type of auto loan next to that client. So like I said, very important credit mixture. You don't want to have just one card. I come across sometimes people that just say, I'm living off just one credit card. That's it. I don't want additional debt. I don't need any additional debt. But let's say something happens, right? Where economy is doing pretty bad. They need access to money. Unfortunately, because they haven't built their profile, they're going to have a harder time accessing bigger loans, 30K, 60K, 70K, and so forth, because they just don't have anything that the bank can work with. They only have one credit card. So less accounts means a weak profile. More accounts means stronger profile, okay? And it's a mixture of different accounts from student loans, mortgage loans, auto loans, personal loans, credit cards. All these different types of products is what creates a mixture, a strong, solid foundation. This is what your credit should not look like. I'm actually gonna give you an example, what to stay away from. And if it looks like this, hey, don't freak out. We can actually help you. All you have to do is just send it a DM saying credit. And then from there, we can go ahead and check out what you have going on. What's the best way to get back on track if these things are affecting your overall credit, okay? So showing you here, we're seeing an overall credit limit of about 7,000, right? We talked about utilization being a big factor, making up about 30% of your score. If you look here, we have a balance of about $6,879. That is over 90% already usage reporting to Equifax, TransUnion, and Experian. We see it all across the board here. Now, when we're seeing this is a big reason why this person's credit is low, right? The next thing we're gonna look at is here. This is the on-time payment section, right? We talked about payment history, that being another big factor of your credit score, right? Here we see 30, 60, 60, 60. That means this client here was late 30 days, 60 days, 60 days, and 60 days again. So that is something that will weigh down your credit report. And if you're looking to buy a home too, or get an auto loan, if the bank sees this, that is recent, you're definitely gonna have either super, super high interest with a big down payment, or you're gonna get an automatic denial. So we want to make sure that we get these things fixed, right? Avoid applying and hurting your credit overall, and then start restructuring your credit profile, okay? Now, the next example I'm gonna give you is someone that has taken care of their overall credit and what your credit report should be reporting as well. This is the example that I'm talking to you guys about when it comes to having a good reporting account, okay? So here we're gonna look at the overall credit limit for this credit card specifically. It's about $35,000. Now, if we look at the balance here, we're seeing $0 reporting to all three credit reporting agencies, which puts us at zero is zero, right? 0% usage happening. So with this being at its super lowest, right, zero, it's allowing the person to benefit the most when it comes to credit reporting, right? 30% of your score is usage. No usage means 100% success there. Now, the next thing that we're gonna look at here on the profile is the overall on-time payments. This is what your credit should be showing you on time, on time, on time, on time. When it comes to a credit card, the best way to avoid any late payments like the previous file I showed you is by just having your credit cards on auto pay. That is one of the easiest things you can set up by logging into your credit card account or calling in and getting assistance on how you can set up that auto pay. That helps you avoid the headache, having to go through credit repair, and now you can have an on-time payment record here. Okay, so this is what it needs to look like on your side event. If you found this information valuable, understanding the fundamentals of credit and how to leverage credit to access capital and start investing, start going into that entrepreneurship journey maybe you've always thought about, you need to stay tuned. follow us here at YouTube or follow us on our social media pages. You're going to see the links down below in the description. And I'll see you guys soon. Let's go.